Hey there, this is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. Today I want to go over a fantastic tax strategy for those who are charitably inclined, giving to your religious organization. It could be a nonprofit, any 501c3, public or private foundation. This can be a fantastic tool because most people, when they give to charity, they don't think about it. They do it from the goodness of their heart. But you have to think from a financial point of view, how can it benefit you as well as the charity equally? So think about it like this. 3 core ways people give money. The first one is just giving money out of their pocket. That could be straight up cash, credit card, or just a check. That is a core way people get and pay charities. You can see it here. That's the first way. Now you get the full write-off. If you give $10,000 cash, you get to write off that full $10,000 against your income, which is great. If you're in the highest tax bracket, you can get back 54 cents on the dollar. Depends on 37% feds, 13% state, and about 4% for Medicare surtax. You could save 54 cents. You give $10,000, that could save you over $5,400 in taxes, which is fantastic. Nothing is wrong with that. But you're taking after-tax money to do that. Look at strategy number 2. This is huge. These are for people that have appreciated assets, folks. That could be a stock. This is the most common one. You buy stock for $1,000. That's your cost basis, and it's currently worth $10,000. You donate that $10,000. You still get the write-off on the $10,000. You do. But the benefit of that is that had a capital gain of $9,000. If you were to sell that $10,000, you would have to pay 23.8% to the feds, and I chose the state of California because it has one of the highest state taxes at 13.3. That's 37% you would have to pay in taxes. Well, 37% on $9,000, that's over $3,300 in taxes you would have to pay. But see, the charity doesn't pay taxes. So when they receive the stock and they sell the $10,000 worth, they put that in their pocket, they pay no taxes at all. You still get the full $10,000 write-off. By the way, the $10,000 you were going to give to the charity, how about you just go ahead and rebuy the stock that you just traded away, assuming you like it? These are fantastic strategies here because what happens is you still get the write-off of the $10,000. So you'll still save that $5,410. And then you also avoided paying $3,300 in taxes. So really, you're giving away $10,000 and it saved you $8,700 and almost $50 in taxes. It's almost like you're getting all the money back. Everybody's a winner here. The charity is a winner because they received the money. The person is the winner because not only they got the full write-off, but they avoided capital gains tax. The only loser here is the IRS. And quite frankly, who cares? They created these rules for you to take advantage of them. Most people just don't take advantage of them. Keep in mind, if your adjusted gross income is $100,000, if you give cash, you can write up to 60% of your AGI. Now, who, quite frankly, is going to donate $60,000 a year to only make $100,000? Now, if you give stock, it's only 30%. Just FYI, yet again. $30,000, what you're going to write off. Most people, yet again, who make $100,000 do not donate $30,000 a year. You get what I'm saying? These are fantastic strategies that can help you, yet again, of donating appreciated stock. Now, let's say the charity doesn't take it. They don't have a brokerage account. They don't take appreciated stock. What you can do is open up a donor advised fund. Donor advised fund is a nonprofit in itself. So you take that $10,000 in stock. Let's just say you bought it for $1,000, now worth $10,000. So you put the $10,000 in stock. Let's just say 100 shares of something that's worth $100 a share. You could transfer it in there. You get the write-off because that donor advised fund is a charity in itself. So you get a write-off. Then the donor advised fund sells it. Then they can send a check directly to the charity of your choice. This is fantastic. You could do that through a donor advised fund. You should be talking to a professional if that's something you want to look at, assuming the charity does not have a brokerage account that accepts stocks. But let's continue the conversation. What's another way you can do it? Let's say you're over the age of 72, 73 years old, eventually 75 years old, and you have to take out required minimum distributions. These are fantastic because what you could do is those required minimum distributions up to $100,000 can go directly to charity. So if you have $1 million, RMD is roughly 4%. That's $40,000. You can give that $40,000 directly to charity. Now that's a lot. You don't have to do the whole amount. You can do part of it. Maybe you want to give the $10,000 as an example. You give that $10,000 to charity. You avoid their federal and state taxes yet again. It's a great strategy that I don't see people taking advantage of enough. Now, the benefit of doing this, it's called a QCD, a qualified charitable distribution. The benefit of doing that is it avoids AGI taxation. So what does that mean? it shows on your taxes that you took out, for example, 10,000, but 0 gets reported. Why is it important? Because you might not be getting write-offs enough, where that write-off will help you. You may be putting in and it's adding to your adjusted gross income. That can affect your Medicare taxation, which lowers your Social Security. So a QCD is the best form to give because it never even hits your tax return. It doesn't hit your AGI, your adjusted gross income. Folks, these are fantastic strategies. I sure hope you're taking advantage of them. If you're not, or if you want additional help, please reach out to us. Our information below. If you like this video, please like it and subscribe to our channel.